You may have heard about selling put options and how it is a fantastic way to generate income, but the only problem is you don't have enough money to buy 100 shares of a certain stock. So here is an alternative to selling put options that could actually generate a sizable amount of income. It does have different risk parameters than just selling put options, but it can definitely benefit your portfolio if done properly. If you're new to my channel, my name's Vijay. I've been trading options for over 7 years, and in these videos, we talk about trading options passively and trading futures actively to ultimately help you retire early. If you want to join me on this journey, hit the like button, smash the subscribe, and let's jump into the lesson. Okay, so you are bullish. You could go ahead and buy a stock right now, or you learned about this fancy thing known as selling put options. Remember, when you sell a put option, you are actually going to collect income immediately. This is how the contract works, and if the stock goes above a certain strike price, you get to basically keep all this money. However, if the stock goes below a certain price, you become obligated to buy the stock, but you want to own it anyways, and the benefit is you got to collect premium, you got to buy it at a lower price, and now you just have to wait for the market to go up. The problem a lot of people have is that they are bullish on a stock, they want to use the strategy, but they don't have enough money to buy 100 shares of the stock. And because of that, they can't just go out and sell put options. Now, there is a way to actually get around this, and there's actually two different ways. And I want to make sure that I'm explicit in saying this. These have different risks. It's not the same one-to-one risk to reward as just selling regular puts. So I do want to make sure I am extremely explicit about this, but these are two different ways you could take advantage of a bullish position without actually owning 100 shares. First method is to use something known as a margin account. This is where it gets risky, because when you are using this type of strategy, you won't actually even have enough cash to be able to buy 100 shares. Basically, the broker will lend you money and you have to put up basically some sort of deposit to make sure that you will be able to do it. But the problem is, if the stock continues going lower and lower, you're going to get a margin call if you don't have enough cash to go into the account. So because of that, this is an extremely risky way to trade, and I do not recommend this at all, especially if you're just getting started. As you get more experience and you start understanding how markets behave, you can actually take advantage of the margin accounts, and that could absolutely benefit you if you know how to manage risk properly. It's all about risk management more than anything with margin accounts. If you do not use proper risk management, you're going to blow your account and you're going to end up owing money to your broker, and that is not a great place to be. So very, very, very important that you follow this. And for that reason, I don't recommend this right now to get started. But as you get more experience, this could be something you check out. The other way to get around not having 100 shares to sell a put option is to sell something called a put credit spread. These are extremely popular strategies that a lot of people in the option selling space use, and we're going to talk about this. Traditionally, you would sell a put option, let's say at $95 strike price. If the stock stays above this, you get to keep money, right? However, if the stock goes below $95, you become obligated to buy 100 shares and you still get to keep this money. But your risk is the stock can go all the way to theoretically $0, which means you are still exposed to $95 worth of risk minus the premium that you collected. And so you're still going to be exposed to at least $90 of risk per share. And remember, each contract is for 100 shares. So that's $9,000 worth of risk. So there is another way to do it. Now, if you remember, put options are basically insurance. When you buy a put option, you are buying insurance. So what you could do is actually, let's draw right over here. You could sell a put option right here at $95. And when you sell this, you would collect income because you're selling this put option. But you don't want to have that much risk. So what you could do is actually buy a put option at $90 strike price. And for this, you would actually have to pay money because you're buying insurance. In this example, someone is paying you money because they bought insurance from you and you are collecting income. You are selling the insurance. If the stock stays above $95, you get to keep this full premium. But what you could do is go to someone else and you could buy insurance at the $90 strike price. And so let's look at a P&L payoff diagram of a put credit spread. Let's say the stock right now is at $100. You would sell a put option at $95, and for this, remember, you collect a premium, but you want to hedge some of the risk, and so you buy another put option at $90. Short is just another way of saying you sold something, in this case the put option, and long is another way of saying you bought something, such as this put option. So let's look at the P&L payoff diagram. If the stock expires out of the money, such as above this $95, you get to keep the premium, and the premium is the difference between how much you received here minus how much you ended up paying here. And you'll notice P&L right here is going to start going down because at $95, you are obligated to buy 100 shares of the stock. However, we're getting closer and closer to this $90 strike price, which means you can actually sell your stock to someone else. So you are going to be taking a loss in between this area, but notice you're still positive, even slightly below $95. And that's because the premium you collected will actually offset a little bit of this cost. But because you did buy this long option right here, your P&L is actually capped. Your maximum loss is capped, as in you already know what the maximum amount of your loss is. And this is the P&L chart for the put credit spread. Basically, if the stock stays above $95, you get to keep all this premium. This is money. However, you'll start losing money after price starts going lower than the $95 strike price. But because you did buy this long option as protection, your P&L is capped, and this is the maximum amount of money you can lose. So where does this strategy make money? We'll make money as long as price is above the short strike, and the break even is the short strike minus the premium you collected by putting on the spread. So right here is kind of that break even spot. So as you can tell, the put credit spread is a great strategy if you are neutral or semi bullish on the stock. But yeah, put credit spreads are probably one of my favorite strategies, but there are other risks associated with it. We actually put together a free email mini course that'll teach you how to use stocks and options to ultimately help you retire early. You could actually just click the link below and sign up for free. If you enjoyed this video, I think you're going to love this video.